Hi, I'm Steve, and welcome to Bytes by Standard Chartered's Global Chief Investment Office. 2026 Outlook: Blowing bubbles? Talk of an asset market bubble is intensifying. However, we believe this equity market rally is backed by strong earnings growth and cash flows. Therefore, we believe investors need to access as many sources of diversified returns as possible to ensure they set up for long-term stability and growth. Why we're optimistic? While the current AI theme is in some regards reminiscent of the dot-com theme of the late 1990s, there are two key differences in our mind. First, in the late 1990s, there was a clear decoupling between the relative performance of tech sector equities and earnings growth. The second reason is that the amount of investment in AI is significantly lower as a percentage of economic activity relative to previous boom cycles. Therefore, we still see the AI investment-led economic recovery as having some way to go. Of course, this does not preclude the risk that we are in the process of blowing a bubble, but we do not think we are near the end of that process. Equity markets typically do very well in the final years of the boom. That said, we cannot ignore the fact that valuations are elevated, and in response, we have three key strategies that can help manage the risk of significant volatility in 2026. First, diversification within equities. We believe proactively managing this concentrated exposure to technology is just good risk management. Therefore, we advocate diversifying both geographically and sectorally within equities. The second strategy is to diversify income sources within portfolios by overweighting emerging market government bonds, both USD denominated and local currency bonds. In our view, EM bonds offer strong credit, higher yields than developed markets, and exposure to non-USD currencies and rate-cutting cycles. The final strategy is to diversify into alternative asset classes. We remain bullish on gold. Central banks remain a source of strong demand for gold, as they try to diversify away from their reliance on G3 government bonds in their FX reserves. We also look to allocation in other areas of alternatives. In private markets, we continue to believe private credit is an attractive area. Hedge fund strategies are also a potential area to diversify into. The final area to consider is digital assets. New year, new concerns, new opportunities. This year, the concern is valuations. Our central scenario is that this may result in bouts of greater volatility, but it will not be enough to constrain equity markets in 2026 as long as earnings continue to deliver. Thank you for watching. See you in the next episode.